And are we on the new house?
Apparently we're live, so
Hooray!
Let's start. Good evening, everyone. This is
Louise Mishevich, and this is
Simon Mishevich, and we are not the
Morecambe and Wise.
We're
not that good.
Hang on my glasses. Good evening and welcome to the Property and Business Tax Live Seminar. This is where you get to ask your questions regards to business, property, or indeed any other type of investments. And one thing I haven't done, Louise.
About tax.
So you can ask us about general stuff if you want to.
I'm not so sure we'll be able to give you the kinds of answers we might if it were a tax question.
Yeah.
But that's not to say we wouldn't try.
So what I'm going to do, which is something I need to have done to start the room. So we're also on Clubhouse.
Hooray! Hello, people in Clubhouse.
Hello to anyone in Clubhouse. So I'll leave that there. So as I say, if you have any questions, then feel free to type those questions. And I'm just going to say hi, everyone, just to see if it's working on that side of things. And it should be. So, what we do in this session is answer your questions about business, property, tax, as Louise just pointed out. So let's start, Louise, with a nice warm-up question.
Oh, I know your warm-ups.
Now,
They're normally fiery hot.
When we talk about warming up, we talk about death, unfortunately.
See, I knew it was going to be fiery hot.
So it depends if you're in the Mephisto world.
Stop it.
Of Marvel. So we need to worry about inheritance tax. So how much money can you inherit before you pay inheritance tax? Let's talk about what inheritance tax is before we crawl straight through the details. What is inheritance tax, please?
So inheritance tax is HMRC's method of sadly grabbing you beyond the grave, so to speak, and making sure that whatever your worldly assets were worth at the point of your death, a tax is paid based upon their value. There are some carve-outs and exemptions, which is good news, and we'll maybe talk about those depending upon the questions. But broadly, if your worldwide and ownership of assets is over a certain value, then you're likely to have your estate have to pay out 40% in inheritance tax on everything above a certain value. And it's a tax that is genuinely taxed on the person who has died, and it is administered, of course, they can't do it once they're gone, bless them, but it's administered by typically someone called an executor who will be identified prior to the person's death in their will, determining who is going to sort out all the administration and make sure all the assets are actually handed over to the right people. It's going to be their job to work out how much tax is due, to work out what assets they're going to either have to sell or what cash they're going to have to use to pay that tax. And then whatever is left over is then going to be shared on with the beneficiaries of the will. So the people that potentially you want to inherit all the items that you will have at your death.
And in terms of inheritance tax, how much people are paid percentage-wise of, let's ignore all the exclusions.
Sure.
If you've got £100,000 that's over and above the exclusion amounts.
So in other words, it's going to be
taxable. How much you pay?
Well, sadly, and I think I might have said this already, so I do apologise, 40%. So for example, for every £100,000 that's going to be taxable under inheritance tax, kiss goodbye to £40,000. A lot of money.
And the reason why I want to highlight this is because people do focus on very much about growing wealth. And they say, well, I'm building my assets up in order to pass it on to the children. But as Chenji Meng, who is on the panel members for HK2 UK, which is coming your way this Thursday at 3:30 p.m.
Oh, he couldn't help plugging it, could he?
Yeah, I just couldn't help plug that. So if you're from Hong Kong, you want to know about tax and law, then make sure you join us on Thursday. But apart from that, one thing he did say was, if you're raising an asset base or increasing your wealth by £100,000, make sure that you include Uncle HMRC into your will.
Yes.
Because that's technically what we're all doing if we're not careful. So it's one of the key things. And I frequently have these conversations. You know, I had one today, I had one last week. I'm going to have one every week, I have no doubt, about inheritance tax. And the one thing that I always say, it's based on net assets. So one of the things that you could do, a couple of things you can do. One, increase your debt, because debt brings down your net asset value. And because of that, you will pay less inheritance tax. But hark, you then have cash instead of in terms of assets. So you've not really done anything unless you spend all that money. So the other side to it is gift your assets to your children.
Whilst you're alive, maybe.
Whilst you're alive.
And they can enjoy it with you.
But then what tax have you got for that?
Oh, that's when capital gains tax triggers. So for me, whilst you're alive, if you try and give some assets away, then you're caught often by capital gains tax. But the tinker that HMRC is gets you when you're dead, because actually, if that's the point you choose to give your assets, well, capital gains tax, that doesn't apply anymore, because that only applies to living, breathing people. But now you're passed away. Instead, we'll get you with inheritance tax. But here's the kicker. Capital gains tax at its highest rate is 28%. And that puts a lot of people off from gifting. And I get that, completely understand that. So would you prefer to have your family inherit 40% less of your assets or 28% less of your assets? Big question.
Well, there is a debating point though, Louise, in terms of saying that someone gifting an asset paying capital gains tax, does it reduce your IHT? Let's say that you pay your CGT 28% if it's a residential property.
Sure.
But you die the following year.
Now this is where HMRC still gets you. Depending upon who you gave that asset to, if it was somebody connected to you or in your family, there's a very strong chance that that's still going to be caught by inheritance tax. And you may have heard of the 7-year rule. What the 7-year rule says is that if you were to gift an asset to somebody and get nothing in return, yes, you might pick up capital gains tax at the removal of the asset from your estate. But actually, after 7 years, it's technically not possible for HMRC to claw that money back and put it subject to inheritance tax. If, however, you pass away within the 7 years in which you gave the gift, then depending upon how long ago it was you gave the gift compared to when you pass on, will determine how much is still caught by inheritance tax. And this is the nasty. So to Simon's example, in the first 3 years after you gift an asset away in your life, if you die in those 3 years, your inheritance tax item on that particular thing is still probably 40%. If, however, you die year 4 after giving the gift.
Well, can we just stop there? Because I think it's really important for people listening in to understand the intricacies of capital gains tax and inheritance tax. So let's imagine that you've gifted it away in assets and it had, I don't know, it was worth nothing and it's now worth £100,000. So we're talking about shares as for an example.
Okay.
But it's still worth £100,000. It was worth nothing. Now it's £100,000. You had a gain. So the person gifting it pays 20% tax because of the higher rate taxpayer. That's capital gains tax. So £20,000.
20% because it's shares, not property, just in case you were going to say, but hang on a minute, Simon, it's 18 or 28.
As a high rate taxpayer for sure. But let's focus now on year 2. They died.
Okay.
Do they get credit for that CGT?
That's a great question. What do you think, guys? What do you think the answer is going to be?
Because it would sound fair if you paid, if your asset was bought in, you paid capital gains tax, but then the asset was bought back in, you got £40,000 inheritance tax. You've already paid £20,000 CGT, so surely it's only fair to get the credit.
In most cases, you will get an element of credit. So that's the good news. There are some situations that you won't, and I'm not going to go into that level of detail on this particular webinar. But the good news is there is an interplay between capital gains tax and inheritance tax, depending upon how soon those two triggers of tax were caused.
But you do need to be very, very careful, because some people say, well, make a gift of assets to reduce the tax that you pay through gifting. But if you, and I had a call very similar to this today, whereby the first person was quite terminal and they asked, should I make gifts? And I said, well, it's unlikely you're going to benefit from them because it's going to be brought back in. You're going to be hit with this 40%. There's a potential where you don't get the credit for the capital gains tax, and therefore you pay 40% as well. And you have to be very careful with how things are planned out with your estate. So always be very, very careful with that in mind.
The other thing I would say as well as to in a terminal situation, which is a really sad place to be, and I'm not going to dwell on this because we've got lots of other things to help you with regards to inheritance tax. But sometimes, to Simon's point, it's better not to gift the asset because, would you believe it, inheritance tax in certain situations is payable over a 10-year period. Yeah, you heard it here. You can actually pay your tax bill over 10 years when it's inheritance tax for certain types and categories of inherited item. Capital gains tax, of course, though, is now payable in certain circumstances within 30 days of completion of sale. And of course, sale in the example we're talking about might be no money changing hands. It's a gift. So actually, would you prefer to pay your tax in 30 days or over a 10-year period? The choice is yours.
A very interesting point. Second question that's related, and I'm just going to put them all together into the relation. So here's the second question: gifts. Okay, so
yes,
gifts.
Please.
Yeah. You haven't been a good girl.
Oh.
Gifts. Do you get gifts and in your lifetime? So Louise talks about making a gift during lifetime. What happens in that gift scenario, and how do you calculate it? Because as Louise said, during your lifetime, if you make a gift within 7 years, then it could be pulled back in. You may or may not have paid capital gains tax. So let's say that you gifted away your home, well, you wouldn't have to pay capital gains tax because of private residence relief. So that's sometimes a good way to maneuver. But let's imagine, Louise, that someone's made a gift in year 2000. They passed away in 2004. I know we're kind of going back in time, but my simple math, it works.
Keep going.
What happens in that situation in terms of people from YouTube now thinking, crikey, have I just lost have I gone back in time? Back to the future. Yeah. But what happens? I mean, someone's just made a gift for 4 years ago. Who should have recorded that gift? Do you notify HMRC of that gift? And how does it come into the equation of IHT?
Oh, lots of questions there. So
let's hope you've got some good answers.
I'll do my best.
Yeah.
So if the gift is not an exempt gift, and I'm not going to jump into lots of detail on what an exempt gift is because there's lots of interpretations and conditions and details, but imagining it is not an exempt gift, it is the responsibility of both the donor and the donee, so the person gifting and the person receiving respectively, to keep a record of what they were given, how much it was valued at the time it was given, and the date it was given. It's an expectation, and it's not written down anywhere that I know of in normal day-to-day activity, unless, of course, you're checking the HMRC website on a daily basis, which we do because we love it. But it's expected that the donor, so the person giving the gift, should capture this in writing somewhere that would be accessible by the executor of their will and their estate, so that they can take that into account when they're looking at the tax to pay, the estate, and what to include in the estate for valuation purposes. So you heard it here first, guys. If you're giving things away, it really is incumbent upon you to keep a copy of those documents. But I cannot tell you anywhere that you would see such logical common sense written other than on a HMRC fact find.
The one thing I would say about all of this is mum, dad give some assets away and they appoint an executor. An executor, my understanding, is a legal responsibility. So the person is similar to a trustee. If the person nominated and they may not even receive any of these gifts, but if it's found that the person, the parents were gifting stuff through, and technically speaking, you are the executor or you're the trustee, you should know about these financial transactions that goes on. Could HMRC, the eye of Sauron, look upon you and burn you to the ground? Because technically speaking, you are a legal responsibility. So do be always hesitant when anyone says, would you be my executor? Would you be my trustee? Be very careful, because I think you've got a lot of responsibilities that you may not have any benefits at all from this estate, and yet you could be penalized. You could face a fine. And I think there's a challenge where the HMRC can actually go for you if there's no tax.
Yes, they can, because arguably you're in control of the estate. So I would always say to somebody who has been asked to be an executor, either to family or friends, it's an honor and it's a massive responsibility. Do not say yes lightly. Go and research the responsibilities you have, both legal and moral, and go and be certain you can actually perform those duties to the letter of the law before you absolutely say yes.
I think we can leave it there. We are live, so if you do have any questions, then please feel free to
I hope we've not put you off.
Well, there's a couple of people who asked the question, and we'll come back to the non-related stuff in a second, but it was what Emma Cutmore, sorry, has said, what if the gift is cash, not property? Well, with cash, you don't have a capital gain because it's not appreciated in value. So there's no capital gains tax, but it still has to be noted that it's a gift. You have to then put, potentially, that could be what they call the potential exempt transfer because it's over and above your IHT lifetime allowance.
There is a certain amount that can be gifted in value, whether that be cash, coin, shares, whatever it is. I think my little boy would like it in sweets. But you can gift up to typically about £3,000 a year, however you like, and that is an exempt amount. And if you've not yet done it for the prior year, you're allowed to double up right now as though you had put £3,000 through as a gift to somebody or a group of people back in 2021 tax year, as well as do £3,000 21-22. So you could give away tomorrow if you wanted to £6,000.
Can I be honest though? I mean, as much as HMRC and the law is written in there, I think it's such a piddly, pathetic amount.
It's horrendously small, and there are other exempt amounts, and there are other exemptions,
like
but that's
wedding gifts and whatever nonsense.
But also living costs that are normal. So
I'm sorry, but no, it's nonsense. Move on. Right. So now we're talking about. Not only have you got each person, by the way, just a recap for inheritance tax purposes, is what the total is when you've got a home. Okay, so we've got a home.
Okay.
Now. So let's imagine that's all they have. And,
okay.
and it's an asset value. But let's imagine that the property is worth 1 million now.
Ooh, okay.
£1 million. Now, we know a husband and wife, mum, dad, wants to pass this £1 million home to their child, their sole child. Technically speaking, we've just said that inheritance tax lifetime allowance is £325,000. So add that together because husband and wife and civil partners, whatever, gets this amount. So that's 650,000. So arguably speaking, there's 350,000 that's subject to inheritance tax. But
great question. And there is a big but, and it's a good but. There's something called the residential nil rate band. I do like my R's. So what Simon's just been talking about on the 325 is often referred to as the nil rate band, or NRB. What was introduced a few years ago was a top up to that called the RNRB, residential nil rate band. And that adds on top of everybody's individual 325,000, it adds a further up to 175,000. So in other words, mum has $500,000 that she can gift, and dad has, or rather can have as an asset without inheritance tax, and dad can have $500,000, so long as at least £175,000 for each person is the home. Now, in Simon's example, £1 million home, the good news is if that was all they had to gift, there would be no inheritance tax because each of them would be able to utilise in full the residential nil rate band and the nil rate band.
Okay, so let's spruce this up a little bit. Ooh. 10 million.
10 million.
10 million. So in that regard then, that means that you have just 9 million to be subject to 4% tax.
Now. Stop making logical, sensible assumptions.
All right. So what happens?
Sadly, when your estate each jumps to £2.2 million, for every £2 it goes above 2.2 million, I'm afraid you lose £1 of your residential nil rate band. So that means, sadly, by the time you add on something like 2.5 something million, you've lost that £135,000 worth of nil rate band. So sadly, if you're giving, let's say, 10 million estate to your children, you're sadly going to have only the first £650,000 available. That's assuming mum and dad pass at the same time, which would be ridiculously sad, but just imagining for a second. 650,000 is protected from inheritance tax, but I'm afraid 9.35 million.
Well, interesting enough, just a cap on that, just looking at this, R and RB or tapers for estates worth more than 2 million.
Ah, it's 2 million. Okay, my apologies.
So it does go back, but the reason why it's 2.25 million is because that's when it completely cuts away.
Yeah. So
if you've got an asset that is of that 10 million, then you would lose it. You would actually go back to that 650,000. So you would then be subject to an awful lot of tax. Again, it's worth you really understanding, because a lot of what I would say to people is you can gift your home a part of your life, and then that's where you've got this 7-year rule. And typically a house or home is the most valuable asset that parents would own. So the one thing that you need to bear in mind is that if you gift a home and your parents still live there and they don't pay market rent, which is a commercial transaction, what's that considered?
Ah, that's a gift, but with reservation of benefit. What does that really mean? It means you don't get out of the tax on the 10 mil.
Yeah, it means you haven't really made the gift, because basically what's happening is that the parents aren't paying your market rent, therefore they're living as though they are enjoying it like they did before. So really that transfer is nothing more than a tax dodge, really. So you need to legitimately gift that asset over to your children during your lifetime and pay them market rent,
or move out,
move out and show them, or just the fact that you can pay market rent and pay them money into your bank account. That's enough. You don't really need to move out.
Don't forget that market rent paid to your children. Got to show as a rental income on their personal tax return.
Yeah, that's the other side to it as well, isn't it? Okay.
There's no escape. Sorry.
We're still talking about inheritance tax, but this time life insurance policies.
Ooh, good.
So life insurance policies. So what are they and why should you use them? Well, typically people will use insurance policies to pay for things like debt, and we'll cover that in mortgages typically, but for property investors especially. You've got mortgages, then you've got the inheritance tax bill. Now, for a lot of people, if they've tied their money up in property, it's fair to say that they haven't got liquid cash. Liquid cash means that they can just take it out of a bank account and pay the inheritance tax bill and pay mortgages. Why do you need to think about mortgages upon someone's death? Because typically mortgage lenders will want their debt to be paid off within 12 months. So not only have you got this looming thing of inheritance tax, but a lot of our clients, we're trying to educate them to say, well, what about the mortgage debt? Because if you're in a situation whereby you've got inheritance tax and you've got mortgage to pay off, all of a sudden you could be faced to selling your properties off at the wrong time of the economic cycle, recession, which means you get very little money for the properties. The assets and wealth your parents been building up is being dwindled away, and you are at the time you're emotional, you're obviously going through a lot of grief, but now you're seeing these assets also dwindling in value, and you're going to feel quite aggrieved.
It's going to feel like a fire sale if you're not careful, and a very unpleasant one at that.
So what a lot of people do is use a life insurance product that they pay to, and we pay into a life insurance product. And it will basically pay out a sum of money. And there are two policies. There's one called Gary Hands of MG Wealth. Will kill me if I get this wrong. Genji Meng, don't tell him. But the first one is whereby you've got on first person, where the policy pays out, or on second person. So basically both parties die before the insurance is paid out, which is often the cheapest option. And what some people do by mistake, they have a policy, let's say of, I don't know, £100,000 being paid out, and it goes into the estate. What happens to that 100,000?
Ah, very helpful. Thank you very much, says HMRC. We'll just add that to the estate value and tax it. 40% comes back to us straight away. Thank you so much.
So a complete waste of time. So please do check your insurance policies to make sure that the insurance money is written into trust for the benefit of your children or anyone else that you want to, because otherwise you're going to lose your life insurance policy to HMRC. So always have your life insurance that's paid into a trust, and then it can pay the inheritance tax bill and potentially some mortgages. Now, 100,000, I appreciate it's not good to do that. So you might need to think about, well, how much money do I need to have on my insurance policy in order to pay my mortgages and to pay off my inheritance tax bill? Anything else to add from you on that one?
I don't think so. I think you summarised it beautifully.
I practiced.
I can tell.
So let's go to some other questions. I'm going to go to the live questions now because we are live. So,
and I will say, I do apologise. This is a really heavy topic, and we're not going to be able to do it absolute justice. As with any tax topic, I know I say this every time. I'm sorry. There's a lot here, and there's a lot to understand. There's also a lot you could misunderstand. So please don't worry if it's kind of going over your head a bit. Go talk to your tax advisor. Go talk to your solicitors if you're putting together a will currently. That could be a great opportunity to get your head around some key things. But don't do that in isolation. So don't speak to your solicitor and don't speak to your tax advisor in isolation. Make sure you're talking across the two, because there are differences in the approach that will have different legal ramifications as well as tax ramifications. And they've both got your side. They've both got you, in their firm eyesights to support you.
The eye of Sauron.
But, well, hopefully not the eye of Sauron necessarily. But they may be approaching things that means that they could be at loggerheads if you're not careful. And you need to make sure it all sings sweetly together.
So let's go to the questions that are live, and then we'll come back to the pre-fact questions.
Great.
Wow, again, we had my Bella Spicy family.
Hello again.
Hello. I hope I'm getting this right, by the way, your name. It says, I own buy-to-let in my own name. Just want to confirm that I deduct my allowable expense, repair or white goods bought for rental. Is that right? Interesting. White goods. So let's think about this. Repairs. There is a saying that we have in our office. What is that?
Repair, replace, renew. The 3 R's.
The 3 R's, which is, well, I like to call them REs because it is a sermon, religious education. We're educating you, sermons. This is a sermon.
It's so not a sermon.
It's a sermon. And you're blessed with our knowledge.
Oh dear. I told you the jokes just get worse. I do apologize.
So we're talking about repairs, and we'll also talk about white goods. So wherever you've got this repair, replace, renew, and let's quickly go through some examples. So what might you repair, Louise, quickly?
I might repair a dented wall.
A dented wall, replaster work, repaint, that kind of thing. What about replace?
Replace, I might replace a kitchen worktop that's been damaged.
Yeah. Well, that would be a replacement though.
That's what I said.
Yeah. Replace. However, replace, I always say a bathroom suite or a kitchen suite in its
entirety. You might.
I would, and I'm right. Renewal.
Oh,
here we go. Let's test you.
Go on, you tell me.
Repainting. Renewal is just to refreshen up, in my view. See what I did there?
Someone needs to freshen up, that's for sure.
So those costs will be allowed. But interesting enough, when we talk about white goods, well, they're capital. So if you've got a HMO, hold on. So if you've got a white good that you're buying for the very first time in a property of a HMO, then that would be capital in nature. But if you're buying an existing property that's got a poor fridge in there and not so good, you might want to replace that fridge, and then you still get that cost as allowable costs. What was you going to say?
I let him off. He did finish it very well.
See that. Right. So you do, hopefully that's answered that question. Second question that my Bella Spicy family has got. Okay. Second is international travel expense deductible if you're meeting a different investor during that travel, and what evidence is required. Unfortunately, getting a holiday is not allowed. But if you've got genuine business whereby you are, and I've had this debate before with HMRC, interesting enough, I've asked the question. Let's say that you go to Spain, Espanol, with your sombrero.
Sorry.
And your maracas, of course.
I'm so sorry. We really are not.
Flamingo.
Morecambe and Wise.
Oh, that's Florida. Oh, dear. Right, so anyway, you're moving on. So if you go to a different country, you don't buy a property, do HMRC allow that expense? No. They need to know that you actually bought a property. And if you've bought a property and you go and see that property, that cost would be allowable. But you have to physically own the property, which is very different to business, because in business,
Limited company is what
limited companies especially, but yeah, if you're going out to start a business in a different country and you have meetings, you've got agendas, you've got courses that you attend, but you have got legitimate good reason to be there, even as a business, then HMRC are a little bit more lenient in terms of that international travel and allowing it. But property investors, no. If you are buying a property, fine. If you are not able to buy a property, it's called abortive costs, which technically will not be allowed from a tax relief. So sorry about that. Just going on to Suntok. Suntok, hello.
Hello again, Suntok.
Can you buy an antique and gift it without CGT?
Oh.
£6,000 gain you can make on an antique. There you go. So you can make a £6,000 gain on an antique, coins, that kind of stuff. You can make gains of £6,000 and then pass it on to your kids without paying any CGT.
Watches and clocks, no gains, no capital gains tax at all on such items. Came up in one of my exams actually for inheritance tax, very amusingly. And then the other thing just to bear in mind is that there are certain types of assets, and I'm desperately trying to think what they're called, and my brain has gone dead.
Husbands. Very valuable.
They're not, they're a liability.
Right.
Anyway, coming back to the topic in hand, there is a particular type of asset that so long as you make it available to the public, and it is like listed buildings, don't quote me, it's not specific to listed buildings, but if there are certain assets that are considered of a particular type, then actually you might find yourself in a place where you pay no inheritance tax on them. I think you still might end up paying capital gains tax, I'm afraid, if you move them as a gift during your life. But if you hand them on at death, I think there is a way to get out of inheritance tax. And I will double check it and see if I can remember it whilst we're online.
Do you want to do that with that famous iPad?
Thank you.
Whilst we do that, you're very welcome, Suntok. I'm glad that we've helped. And this is a live show. So if you are, and I appreciate we are on Clubhouse as well, but Clubhouse is not so, it's not so easy to get questions answered on that one just yet, because there's no typing functionality. So that's always a bit more trickier. But if you are live on our other streams such as YouTube, Facebook, Twitter, LinkedIn, even Daily Motion tonight, first time that we're on there, then please feel free to type in your questions and we'll get onto those. I can see Louise is
I'm
trying
having absolute rubbish with this tech. Please, can you sort it?
I'm not going to make any comment other than...
You can't do it either.
Well, you know, it's not the fact I can't do it, it's I'm not sure why he was on that screen.
Me neither.
To be fair.
Thank you.
Right, so let's go back to the questions that were being pre-programmed before. Alfred Lee. In fact, shall we do that? No, we've got Vanessa again. Vanessa from last time asked a question, and I don't think we got around to it, so here we are now. Are you able to explain how transferring your buy-to-let property into a limited company might help with any capital gains tax? And one of the things I talked about on other videos in our YouTube gallery of videos is the transfer of a buy-to-let property into a limited company from your own personal name. Okay. A couple of things we need to think about here is you've got two lots of taxes, really. You've got capital gains tax and stamp duty land tax. There's no, if you are transferring an asset like a buy-to-let property into a limited company, which is also owned by you, then you have to pay stamp duty land tax at the normal standard rates, plus the 3% SDRT high rate as well. So that's a hefty tax to pay. And if you make gains, so let's say that a property is worth £200,000 and it was worth £100,000 when you bought it, you have £100,000 gain. Ignoring CGT annual allowances, it could be taxed at 18% as a basic rate taxpayer, 28% as a high rate taxpayer. Have I done that right? 18% as a basic rate taxpayer, 28% as a high rate taxpayer. I'm not sure if I just got the words mixed up. Therefore, I often say to people, it's not really worth it. Okay. But there are things that you can do, such as incorporation relief. So you could have a partnership, move your properties after 3 years from that partnership into a limited company and claim incorporation relief, which means you do not necessarily need to pay capital gains tax, and you can avoid stamp duty land tax as well. Hefty subject area, and we'll have to do a whole video just on that subject in isolation. But do have a look at incorporation relief. We have done that video somewhere else, so do have a look at that, Vanessa. Alfred Lee said, in the short term, I need to prepare a corporate tax return and wonder what type of costs and expenses that arise from property purchase, i.e. legal fees, survey, etc., from refurb, revenue, capital are tax deductible. And we've already covered the allowable costs, but I would say that you are allowed to offset business-related expenses. So not only, let's mention you buy a property. Okay, you've got to look a property in there. Let's make the numbers really simple here. You've got a property, £100,000. You'll have a mortgage of £75,000, which is 75%. And then 25% will be introduced by you, the limited company shareholder and director, potentially. That £25,000 as a direct loan, you could charge interest to that limited company. And that interest is a tax deduction for the limited company. So there's the first cost, even before you get go. You know, you haven't bought a property, but you've got this interest that some of that interest can also be earned by you tax-free. So there are many ways of which you can get tax-free interest, but from a limited company perspective, which is what the question is all about, you can have the interest cost as a deduction. Buying a property, we've already talked about things like repair, replace, renew. So let's just go into this scenario. £100,000 property is below market value for good reason. This property has got really, let's think about the kitchen. It's a 1970s kitchen. The wiring is shot. The radiators and the plumbing heats one room, but no other room in the house. And we've all been in one of those houses. You've also got the nice salmon coloured bathroom suite.
Not avocado green.
Or the avocado green. We've had one of those, which are all shocking. And what you might have to do is you might have to say, well, we'll replace. Do note the word replace. I'm emphasizing this word now. So replace the bathroom suite, the kitchen suite. That is a cost deduction straight away. So that can go against your income, which is a huge amount of cost. You might decide to repair some of the chimney stacks if it's broken, or if you've got outside walls that are broken, you need to repair those. That would be allowed. If you then repair, renew everything, so replastering, repainting, repapering if you want, all of those things would be a tax deduction for the property itself. So all of those expenses you could offset against your limited company, or indeed your own personal name, but we are focusing on limited companies right now. And as a result of that, you could amass quite a lot of costs. But not only that, we focus now on you, the director, claiming interest against the company. You might also choose to take some wages out of the limited company if you're not earning elsewhere. So you've got wages, interest, the repair, the replace, the renews. You've also got office expenditure. So you may well have licenses in which to use Microsoft Outlook or Office. You may be using NRLA and the membership for that. You might have a property course that you're on and you want to expense that against your limited company. In all honesty, there's so many expensive running costs, like mileage. If you are using a company car, don't do that. Charge your company mileage, 45 pence for the first 10,000 miles, 25p thereafter. You can rack up easily about £4,000 in just travel. Where could you travel to? Well, you might travel to the letting agent, the estate agent, the networking events, seeing the property, seeing other landlords, JV partners.
Being cute for the repair items that Simon's just told you need to go do.
Absolutely. And then there's the actual cost of, if you are staying away, you'll have the hotel fees, you'll have some sustenance because you will have to have some food whilst you're away. Don't be too lavish because HMRC will penalise you. They'll only give you up to about £25 per day, roughly speaking, for evening meal, £5 for breakfast, and maybe £10 at lunch. So it's not big money, but all these kind of fees, or sort of in your limited company, starts to amass. And if you start making lots and lots of profit, then you might want to think about pension contributions. So realistically, if you use a limited company, there are ways of minimizing your corporation tax liability. So hopefully, Alfred, that's helped you understand that. Louise, you've got some insights on what
hot
subject?
off the press, hot off the press.
Yeah, go on.
I had to go back to the Inheritance Tax Act 1984. I know you all know it very well. You already know what I'm going to tell you, don't you? I'm going to tell you it's Section 31. Of course you say. Of course, Louise, it's Section 31.
Even my eyes widened with that one.
Exactly. Heritage property. I want you to keep that in your brains, because if you happen to gift heritage property, either as a gift during your life or at your death, so long as it meets the criteria it needs to, which of course Section 31 tells you, it's inheritance tax free. What, you ask, makes up heritage property? Well, it's not just what you would think, property meaning buildings. It could be land. It could even be books, manuscripts, pieces of art, scientific objects, anything that has a particular heritage aspect to it. And you've got to meet certain criteria, and you've got to get HMRC's approval. But assuming you do, that asset can be passed from generation to generation, completely inheritance tax free. The conditions are painful for some items because you've got to make them publicly available for a certain number of days or hours per year. But actually, they're not unfeasible. If they are genuinely all the things that I've just described, heritage property, then there may well be groups or individuals that would expect or need to see it, maybe even want to maintain it for you. So actually, heritage property is something, Section 31, Inheritance Tax Act 1984, that you might learn to love.
I'm sorry, but you've turned into a bit of a geek.
Sorry.
The other thing I liked about inheritance tax, just on the quicker side, alpacas. Okay, so
I knew he was going to raise this. I knew
Jackie
it.
Edwards, big shout out to
Hey,
the
Jackie.
rent queen that she is. So a long time ago, we were talking about agriculture, and I don't know much about agriculture stuff anyway. And she was talking about inheritance tax, and she's buying this farm. And interestingly enough, this tax consultant spoke to her about, well, if you have a couple of alpacas, then your land would be free from IHT. So what? That was interesting. And if you have your premises open to the public for public viewings of your property, that too, isn't that part of heritage property? So you have to have it open for a certain number of days. You'll have an alpaca farm, charge people to go into your house, and then it not be subject to inheritance tax. What? Sorry, I was doing an internship there.
You were?
Yeah.
You're no Vince Vaughn.
No.
I'm saying no more.
Mr. Owen Wilson.
I'm no Owen Wilson.
So let's move on. So we've got Emma Cutsmore, funny enough. She's back.
Hey, Emma.
With a pre-programmed question this time. So Emma asked us beforehand, general advice to start up a limited company service accommodation business. What expenses can be claimed against AFL? Now, I think I've just covered that off, Emma, in terms of what costs are allowable for limited companies. So I am going to distill that away. Do you want to tackle about the service accommodation business there? Because that is your baby, isn't it?
It is. I love service accommodation. So when we talk about service accommodation, I'm referring to it meeting the FHL conditions, furnished holiday let conditions of Help Sheet 253 from HMRC. I know. You already knew that. I know. So Help Sheet 253 is a superb document. Go Google it. It's the HMRC one, HS 253 HMRC. And it gives you all the conditions you need to meet to be classified as a furnished holiday let, whether that be in your personal name or in a limited company or a partnership. The beautiful thing about furnished holiday lets, particularly if they're in your personal name, is it is your get out of jail free card when it comes to Section 24 and mortgage interest. Happy days. You get to treat 100% of your mortgage interest still as a tax deductible expense. Yep, you heard it right. It's still tax deductible so long as you meet all the conditions Help Sheet 253 lays out. The other beautiful thing about furnished holiday lets meeting that condition is that they get lots of other wonderful tax breaks, one of which means that you can actually load some capital items, which Simon told you can't have to help minimize your tax. No. But you can for some for furnished holiday lets. So there's lots of additional expenses that you can suddenly load completely against the profits you're making in a particular tax year. And it will bring down the profit and therefore bring down the tax, whether that be corporation tax because it's in a limited company or personal income tax because it's in your personal names. I shall stop there.
No, that's good insights. I think the other thing to bear in mind is the difference between owning a service accommodation in a personal name versus a limited company, because there are some nuances between those two.
There are.
The first one I would say is Section 24 mortgage interest relief cap. So in your personal name, you are not allowed to offset all of the mortgage interest costs of a standard residential buy-to-let property in your own name, but you can in a limited company.
You certainly can.
So we have to be mindful of that. But if you have a service accommodation in your own name, the Section 24 does not apply to that type of property, and therefore you can offset 100% of the mortgage interest costs against that type of property.
Only if it meets HS 253 conditions, though, remember.
Which is, again, just as a recap, is 210 days available, 105 days actually let, which gives a problem because if your property is in London,
you can't let it for less than, or rather, you can't let it for more than 90 days on short-term lets. And a short-term let is something other than a 6-month AST, as an example.
So really, if you got a service accommodation, it needs to be outside of London now. Because, the parts of London, I should say.
Or it needs to be part of what's called an averaging election, because if you have other serviced accommodations meeting Help Sheet 253 in your personal name in different parts of the country, and on average, when you add up all the short-term nights, they average out at 105 nights per property, bingo, you can have that relief.
That's a good point. Yeah, not thought
but
about
only
that.
for 2 years on the trot.
Oh, is that right? What happens after 2 years?
I think I would need to double check this, but I think certain, because there's two different types. There's something called a period of grace relief, as well as an averaging election.
Right.
And I have a nasty feeling the period of grace dies after 2 years. I think the averaging election, so the one I've just described, might die as well quite quickly. But that would need to be double checked.
So
but it could help you for the first 2 years.
All the way over there.
All the way over there.
All the way over there. My voice is going to be booming now into this.
Goodness gracious.
Okay, so I thought that was quite good. Emma's asked the question, how to show a loan limited company from personal account. So Emma's asking the question, how do you show a director's loan? And back to my previous example, Emma, if you had a property for £100,000, you would have £100,000 as a fixed asset, but it needs to be financed. And the only two ways it can be financed, typically, is through a buy-to-let mortgage at £75,000, and then £25,000, which is your personal loan. And you would use a bank account. So you transfer money from your bank account into the business limited company bank account. And then that money would then go over to your solicitor for the property purchase. And you would use Xero, QuickBooks, or anything else to show those transactions. And then your accountant basically does the rest. I think there's nothing else to worry about on that.
Did that answer your question, Emma? I'm not sure if that was a question. I think it was, but do let us know. Well, I'm just saying. Hashtag.
So let's go to some live. So if you are watching live on YouTube, LinkedIn, wherever you are, then feel free to drop us a question and we'll make sure that we try and answer that. It's already 10 to 9.
No.
It's a shocker. It's a shocker.
How did that happen?
So I want to make sure that we focus on those people that have asked us questions. There's 2 questions that's come out actually that I want to really focus on. VAT, what can you claim back? So let's just talk about VAT. So VAT is a tax that you pay on goods and services, and typically you pay 20%. So if you go to B&Q, normally there's 20% tax charge. If you use a tradesperson, they may or may not be VAT registered. So they may charge 20% VAT and they may not charge VAT. So if you are in a position where you're thinking, I can't really claim back VAT, so should I use a tradesperson that's not VAT registered versus VAT registered, then that's a good challenge to have. Some people say, well, surely if someone's VAT registered, they'll have a better reputation. I don't believe that. I think that's a bit of BS. People talk about, oh, if you're VAT registered or if you've got a limited company, you're a better person. No, you've just got a limited company and VAT, you're still a scumbag. You know, I'm sorry, but you know, it could easily be that kind of person, right? Anyone could be. So I think just having tools and nice spray paint on your car and whatever doesn't make you a good tradesperson. I think what that does lend itself is what can you claim back on VAT? If let's say that you've done a refurb, you've spent £10,000 excluding VAT, £2,000 therefore is VAT. Can you claim it back?
No.
For residential on rent? Why?
No, because it's just not allowed, Simon. Stop trying to bend the rules just because you want to. Hashtag Simon for president. So, unfortunately, in very many cases, if you have incurred VAT on labour and materials when you're repairing, replacing, renewing, to use Simon's phraseology, then although you can add the VAT into your expense, so in Simon's example, let's say it was the £10,000, but you've actually got £12,000 of cost, as simple numbers for a second, 2,000 of which is VAT, which I appreciate isn't quite the way it works, but let's just summarise it for simplicity. Then you can put in your expenses that £12,000. That will be the amount you can reduce your profit by, on which you then charge tax. So you're not losing out. It's just you're not claiming it as fast back, perhaps, as you might, had you been VAT registered and had it been a possibility to claim it. There are, however, examples when you can, aren't there, Simon?
Well, it's sometimes when it depends if you're a property developer. So sometimes you could have a property that you're making residential for the first time, so a commercial to residential, for instance, and then you sell that asset on. That transaction, when you sell the asset, becomes a 0% VAT item, and therefore you can claim back the VAT. Additionally, you could be doing build to rent or creating a building for the first time that's residential. And the tradespeople that are building that construction for you would charge you at 0%. So if you're doing a principal contractor route, then they would do the entire property and not charge you any VAT at all. But that, of course, is where you are doing this VAT 0% rate of creating something new. But let's imagine that you've got a property that is empty, in probate, boarded up. And if it's boarded up, I rather suspect that you'll be able to buy that property, which is here's a catchphrase. You ready for it? Below market value. Have you heard of that phrase before? BMV.
Sorry, people.
I'm sure that's been sprayed all over YouTube at some stage. Below market value. I am quite sarcastic when it comes to below market value. There's another video coming about that. But in this case, let's imagine that you have got some properties being boarded up, empty for a good period of time.
How much time?
In probate, 2 years or more. You can get the refurbishment on that property reduced from 20% to 5%. What it means is that the tradesperson would buy the materials and then they would fix those materials. They would claim back the 20% VAT, which kind of presupposes that they are VAT registered already, and they claim back, but they would charge you at 5%. So instead of paying 20%, you're actually just paying 5%. So you are paying some VAT, which you can't claim back, but at least it's a reduction of 15%. And there are so many different ways of reducing VAT, either as a property investor or a property developer. We're not going to go through all the scenarios on that one.
Okay.
We just one thing about VAT is if you are a service accommodation and your rental income on your service accommodation is above £85,000, what happens then?
Sadly, you're not protected by VAT 1994. You see, I just can't stop mentioning all of the tax legislation. So in VAT 1994, the VAT Act, there is a section that says all these things are exempt from VAT, not 0%, which is what Simon talked about a moment ago, but exempt. And what that means is you can't charge VAT on to someone buying those things. And equally, you can't actually claim back the VAT either if you're buying them from someone, because there is no VAT on them. Serviced accommodation, I'm afraid, isn't in that exempt list, whereas residential lets on AST contracts are. So the moment that your furnished holiday let business meeting help sheet 253 conditions hits the 85,000, 12-month, rolling 12-month period, if you like, threshold for VAT, I'm afraid you need to register that business for VAT. You're going to have to start charging your clients VAT on whatever serviced accommodation rental income you are demanding of them. So that can cause problems if you're not aware of it until the last minute, and suddenly your price seems to hike in comparison to everybody else around you. because I'm afraid VAT does come to the table.
Hayden's asked a question. I'm going to try and
Hayden.
rattle these two questions off, actually, because we're coming to a close. I want to get these two questions because
Go.
these guys have been pre-programmed into it to when they registered. Hayden's asked a question: how to get around the supplementary SDLT charge when buying a property and being based overseas. So just to quick recap, and I'll let Louise go through the details. But if you're buying a property, there are different types of SDLT charges. There's the standard SDLT rate, which is tabled from 125,000 onwards, typically.
Additional.
There's a 3% SDLT surcharge if you've got more than one property or you're buying a property inside a limited company. And finally, as a foreign investor, you've got a
the foreign stamp duty land tax charge, which is an absolute delight, and an extra 2%, and that went live this year. Thank you so much, HMRC. There are ways to deal with it. Unfortunately, if you want to describe it as falling within the conditions of being foreign and you're going to be a part owner of the property, either through the limited company that might be buying it or in your personal names, I'm afraid the 2% applies, and it applies, quite frankly, whether you like it or not. There are times when you can claim it back. So I think you mentioned that you're only temporarily foreign or not based in the UK. Depending upon timescales, and I'm so sorry, Hayden, I can't remember the details off the top of my head, but under certain circumstances, you can actually claim back that foreign allowance. Do you have the details in your mind?
No.
Darn it.
Sorry.
But there might be an opportunity to claim it back. I'm afraid you might find you have to pay it if you fall within the conditions. You fall within the conditions. There is no way around it. But if you then subsequently find you don't fall within the conditions, I'm stating the very obvious, I appreciate, then you might be in a position to claim it back.
Now, Max Chung, I'm definitely going to have to answer his question because he's just finished off saying, thanks for answering in advance, by the way. You guys are awesome. So you rock.
Thank you.
So thank you, Max. This is totally appreciated. Max has asked a question. I have an online training business on stock option investments with some INT software development in startup stage in Hong Kong.
Awesome.
Don't forget, Max, we're going to be live this Thursday at 3:30, but you know that because I think you're registered. I plan to go full-time with my business when I move to the UK. Should I move my training and IT business into the rental company in UK? Or should I keep it in place?
Open another one.
Well, here's the thing, right? Because if, let's imagine here that you've got two business activities, one trade, which is IT, and then property, which is investments. That's a no-no. And it's a no-no because of risk, because if one should affect the other, you have
when you say it's a no-no, do you mean pulling them together?
You shouldn't have it together.
Yes.
So don't mix so in one limited company. No, don't do it. Just retire. But
Sorry.
Don't have one limited company that services both types of activities, one trade, one investments, because of risk. One affects the other. You could lose the assets of all. There are some implications around inheritance tax, which you don't have time to talk about today.
No.
But I certainly would say keep it separate altogether. The big question, Max, really I have for you is in Hong Kong, you have, I believe, it's a 16 or 18% top tax rate in corporation tax, compared to 19%, which is being uplifted to 25% in the UK. If there's a way to keep it in Hong Kong, then maybe that's an avenue, but then you have to worry about, well, if you want to remit that money back to the UK, are you going to be taxed there as well? So I do think get some tax advice on that one in particular. But sure, keep them separate, whatever you do.
And I would say this sounds a really ridiculous thing to say, take holistic tax advice, because understandably, you haven't shared with us and completely get it, whether you're going to be temporarily in the UK, whether you're going to be permanently in the UK, whether you're going to become domiciled here in the UK. All of these things have an implication on your general tax bill as well, because to Simon's point, if you do find that the best tax position per se is to keep your Hong Kong business in a Hong Kong company, and you don't bring any of the profits from that company into the UK, and you're not going to become domiciled here, then there's a chance that you can keep those profits completely outside of HMRC's eye line. The problem with that is that you have to give something up to do so, and that's your personal allowance. And after circa 7 years, HMRC might start charging you, just a small round £30,000 to keep it out of their eye line. Not a good option necessarily for many. So there's a lot of moving parts on this, as I'm sure you've already worked out, Max, and there's lots of things you probably need to go and ask, both in terms of limited company position, but your long-term position tax-wise as well, personally.
I want to focus on one more question before we close, because we are at 9 o'clock and I appreciate people want to go and leave and do more interesting things. But Gary's asked a question.
Hi, Gary.
Saying, hi, Simon, Louise. Good evening to you, sir. Thanks for all the great content and videos. You're very welcome. I came across Building Society recently, which is offering a new direct loan ISA. Just wondering if you've heard this. Just so everyone else is aware of this, what is a direct loan ISA? I'll give a recap, and then hopefully, Louise, you can give some ideas as well. So we talked about a limited company. Let's say we're talking about it buys an asset. It doesn't matter what type of asset, but if it buys an asset for £100,000 and it gets a loan, whether it's a mortgage or a commercial loan, doesn't matter. And that loan just happens to be £50,000. And then you loan it as an individual, £50,000 into the limited company to pay for the other half, then that £100,000 can go out the limited company. But, the limited company now is an asset at £100,000. It's got a debt to the bank from £50,000 in form of loan, mortgages, whatever. And the limited company owes you £50,000. So what can you do? Well, that £50,000 is a debt. You'd expect a commercial rate of return on that. So let's say 8-10% or something daft like that. And that 8-10% can be paid to you as an individual. Now, the problem is with that is that if you are charging, if you've got a £50,000 loan, your interest alone itself might be £5,000 per year, which actually is that's you're going to be taxed on that from an income tax perspective from HMRC on your self-assessment tax return. That's not good either. It's because you've now kind of got a corporation tax relief, but now if you are a high rate taxpayer, you start paying 40% tax. Now, you can earn some interest tax-free, and you do need to get some tax advice because it really does vary from £5,000, I believe. Is that right?
Well, depending upon if you can access things like the personal savings allowance and the savings allowance, you can actually earn up to £6,000 worth of bank interest tax-free here in the UK. But there's a lot of moving parts, and there's a lot of connections as to, well, if you have this kind of income, you can't have that. So there's an awful lot.
Yeah, you do have to be careful. The one thing I would say is that, as a basic rate taxpayer, you can earn £1,000 anyway, tax-free, £500 if you're a high rate taxpayer.
This is interest.
This is interest. But that's way less than £5,000. So the concept of using the direct loan ISA account is whereby your money is set up with an ISA. You have this ISA as a debt to the limited company. The interest then therefore pays via interest from the limited company into your ISA. Well, the ISA grows tax-free. So you then don't have any tax. Now, the problem is with this, and we've done some research for some of our clients, for basic rate taxpayers, it doesn't make sense. And the reason for this is because the institutions that are creating all this kind of stuff are telling people to charge a crazy amount of interest, which goes against HMRC rules and regulations. So you have to be a bit careful about their freedom of marketing information. And it's not tax law, it's marketing information. So you have to be careful about that. And you've also got the stage of, well, their fees. How much tax do you save as a result of this versus how much fees do they charge? So if you're a basic rate taxpayer using an ISA account, then actually you could be paying them, whatever institution is offering these direct loan ISA accounts, more money than tax you're saving. So who's winning? Not you. So it really works if you're a high rate taxpayer, you're moving money in, or additional rate taxpayer, and you're moving money into an ISA account. That can work very, very well, but you do need to be careful.
And just to keep you up to speed, basic rate taxpayers are for 21-22 tax year, the year we're in right now, it means you're earning a total of £50,270 or less. I'm full of facts tonight.
You are always.
Thanks. I'm not sure how to take that.
So just out of interest, if you've enjoyed this session, by the way, do give us a thumbs up. Please do give this video a like. Do share it as well with your peers and WhatsApp groups, whatever, because I think it's fun and useful. We do these sessions every month as well. Louise runs her own show called Self-Assessment Tax Return. So that's in 3 weeks' time.
Self-assessment tax season is here, guys.
But don't forget to subscribe to the channel as well. So if you're watching on LinkedIn, Facebook, give it a like. Do share it with your friends and families. If you are on YouTube, please do come over, give it a subscription, please, because we can then notify you of every video that we will release. So that's really important to do. So
you can hear all of Simon's really bad jokes.
That's shocking. I think my jokes are so
they are
brilliant.
Shocking. I agree. Moving on.
You are shocking after that. Right. So apart from that, thank you ever so much for joining us this evening. We really appreciate the Q&A. Next time when you register, make sure you do that. There is going to be a gift for anyone that registers. Definitely not for you. You don't deserve it. I told you, you need to be a good girl. You're not that. If for anyone who registers, there will be a gift. I'm not saying what it is, so make sure you register for the next time. So make sure you go to our website, www.optimizeaccounts.co.uk, and then look for the live sessions and then register for the next ones. There is one coming up this Thursday, as I mentioned before, for the HK to UK. So if you are traveling from Hong Kong to UK, then make sure you subscribe to that channel. And sorry, that for that event. But apart from that, thank you ever so much for that. And we'll see you all again soon.
It's been a blast as always. Have a good one.
Bye-bye.
Bye.